Hello, everyone, and welcome to the Syndication Attorneys free monthly podcast, Raise Capital Legally podcast and YouTube channel, where we talk about topics of interest to real estate syndicators and fund managers with an opportunity for live questions and answers before we sign off. I'm Krisha Young, the co-host and business development director for the firm, and this is attorney Kim Lisa Taylor, the founder of syndicationattorneys.com. Now, before we get started, please note that audio and video from this event will be posted on our podcast platform, YouTube channel, website, and social media, and will be made available to the public. You can ask questions at the end of the broadcast by raising your hand or typing it in the Q&A. Please note that information discussed during this event is of a general, educational nature and should not be construed as legal advice. I would love to have you join our host, Kim Lisa Taylor, in this insightful episode as we chat with Austin Prevost and possibly Ryan Bakey, CPAs, about the complexities of taxation for limited partners and general partners. We're going to cover the key differences of how LPs and GPs are taxed, strategies for tax savings, and the impact of state taxes. Austin and possibly Ryan also share their expertise in managing both partnership and individual returns, offering valuable advice for anyone involved in partnerships and syndications. And we're going to try to make this fun today, right?
Yeah.
Oh, Ryan's here. Hi, Ryan.
I'm here. Hello.
Hi. Thank you for joining. All right, let's go. Kim, do you want to kick us off?
Sure. Hey, welcome. And thank you, Krisha. And welcome, Austin and Ryan. I would like to say we're excited to talk to you about taxes, but I don't know if that's like true of anybody or like anybody could ever say that.
We're going to try to make it exciting today.
Yeah, I'm sure there's a few, tax attorneys out there that get, really jazzed about it. But anyway, it's an important thing. Of course, we all want to minimize our taxes. We want to, maximize earnings, not just for ourselves, but also for investors. So our clients, whether we want to know this or not, we need to know it. And so we're super happy that you guys decided to come on and tell us. And I think it's timely because here we are at the end of the year, and I would imagine that there's a few things you might recommend people do before like April 1st. Because I know we get a lot of calls around April 1st from people who are panicking. And I'll tell you one of the very first, one of the worst calls that I get that I always very concerned about is people who are using a personal income tax preparer to do their syndication tax returns. And so we get a whole lot of people panicking around, April 1st saying, they're, allocating 30% of the interest to us and we're getting this huge tax bill and we haven't received any money, and so they don't understand that that there is an operating agreement, and two, that the operating agreement directs how they are supposed to allocate things, and they have no comprehension of how to do that. So, is that something you guys encountered? You get a lot of people coming to you saying, hey, we're working with a CPA that doesn't really understand what we're doing?
Yeah,
Guys...
it's every single year. Not with just syndications or K1s, but also cost segregation studies. So a lot of investors are getting cost segregation studies on their residential properties or commercial properties. And it's just like clockwork. March 15th, maybe April 1st, every single year, we get tons of messages of people who are like, well, my CPA said that they knew how to do accelerated depreciation and cost segregation, but here we are, and now I have to file an extension on April 4th, April 10th, even April 15th. And so when you start leveling up in your portfolio or you start investing in syndications, it's also time to start calling some real estate CPAs as well.
Yeah, I'd also add to that, Kim, like a lot of LPs come to us and they think that they can offset rental losses from their syndication against their W-2 business income. This is a big misconception among most limited partners, that their CPA will tell them. So we like to go over different tax strategies like real estate professional status and alternative strategies just to maximize their tax savings. So.
Yeah, and I think those are a lot of things that they're mysteries to a lot of people. Just since you mentioned it, can you tell us, what are the criteria to be designated as a real estate professional, and how does that benefit somebody who's in this
Yeah,
business?
absolutely. So this would mainly apply to the general partner in a syndication. There's two criteria for real estate professional status. The first criteria is 750 hours towards a real property trader business. If we take that 750 hours divided by 52 weeks in the year, that's about 2 business days on the safe side that you have to contribute in the day-to-day operations of a rental activity on a regular and continuous basis. That's criteria one. You also have to substantiate that you're spending more than 50% of your working time towards that real property trader business. So you can't have like a full-time W-2, for example. The other part of that is something called material participation. To break this down for our viewers, material participation is just it's just a fancy word for self-managing your real estate portfolio. There's 7 tests total. I won't get into all of them, but it's basically one of these tests that you've got to satisfy and basically communicate to the IRS that you're involved in the day-to-day operations of syndication.
So just breaking that down again, you mentioned 750 hours in a year divided by 52 weeks. That's like 14 hours, 14 and a half hours a week, or close to 3 hours a day if you're working a 5-day week. So, or, just think 15 hours a week, 60 hours a month. If you think that you're doing that, then it benefits you to get that real estate professional designation. And then tell us again how it does benefit them. Why do it?
So general partners, they're mainly involved in the real estate syndication on a regular and continuous basis. So generally speaking, they'll qualify for that rep status if they're able to satisfy that criteria. What that does, Kim, is it allows them to offset rental losses from the syndication against their W-2 business income.
Oh. Okay. That makes a big deal, right? It's because it's really hard to find any other kind of losses that can be taken against W-2 income, isn't it? I mean, in the real estate space, it's like your passive loss.
And that's why, doing a cost segregation study and utilizing bonus depreciation is super advantageous in syndications because you can basically front load that depreciation to create a net paper loss and use that net paper loss to offset other types of income.
Yeah. And up until 1986, there was no separation of church and state or rental and non-rental income. So the joke used to be 2 doctors buy a rental property. What do you call it?
No, what do you call
A
it?
tax shelter.
Okay.
Because they would use the losses from the rental property to offset their doctor income. And it wasn't until 1986 where Congress pretty much, after 70 years of tax code, they finally put a stop to that by coming out with this and saying, hey, look, you can't use rental losses to offset, active income unless you're this real estate professional designation. And then they put tests and rules around it. And it's probably the most litigated portion of the tax code because you got everybody who's ever owned a rental property that thinks, wants, and tries to qualify as a real estate professional. Yeah.
Okay, but a lot of our clients that are doing this on a regular basis and that this really is their job, and they would definitely qualify. So for sure, if any of the listeners out there have not explored this, you definitely want to explore it, and you can certainly explore it with Ryan and Austin, and they can help you understand how to do that and how to qualify. And it's not too late to do that yet for this year, right? They can still qualify for this year when they file their tax returns.
It's you make the election when you do file your tax return. So we like our clients to keep a log of their time because that's one of the first things that an auditor, if you get, we've defended 2 real estate audits this year. No changes whatsoever. Okay. Meaning that one of them, the taxpayer got a nasty letter saying they owed 180 grand, and another one they got a letter saying they owed something like $80,000, both of which owed nothing because we were able to prove these tests. And one of the ways to prove them is to keep an hour log of your time. And so that can be as simple as an Excel spreadsheet. There's online tools. You pretty much want to just keep track of the day you were doing the work, what property or address, how much time did you spend, what did you do, and then do you got some kind of proof to back it up? Like if you said you went to Home Depot to get parts and come back, do you got a receipt from Home Depot that shows you were working that day, right? Do your credit card statements match what you said. There was a tax court case where the taxpayer claimed to have spent 3 days at his cabin in the Poconos working on it. His credit card statement showed that he was in Europe.
Yeah.
Not good if you're trying to go against an auditor. They will sniff that out 100%. So you really want to be credible. A credible person is what they're looking for when it comes to defending if you ever get audited.
Okay, that's a good point. So I know
Mhm.
there's a ton of apps that you can get on your phone, through the App Store, or, through, like, I guess the Google Store if you are not on an iPhone. But you can get an app on your phone and easily track your time. Same as you can get mileage apps to track your mileage too. Same thing. You got to keep track of where you went, what you went there for, and how it was related to a business purpose, right?
Yeah,
Yep.
there's an app that a lot of our clients use called Reps Tracker to track their real estate professional status hours, and then like Mileage IQ for tracking their miles. So there's a lot of good tools and resources out there.
Did you say reps tracker?
Yes.
Okay. And there's a question here from Raj. Will my calendar meetings, calls, and travel qualify? So travel, I think we already said yes. I would say so.
That's a great question. Our stance for me and Ryan is that traveling to and from the property does not count towards material participation. It does count, however, towards real estate professional status. So to break this down, you've got two sets of hours. You got the 750 hours towards real property trade or business. You also have material participation hours. Okay, so material participation is a test where you've got to satisfy a certain number of hours towards self-managing that rental portfolio. But for the 750 hours that you've got to qualify for, the travel time to and from the property does count.
Yeah,
So,
and our stance a lot too is like if you're banking on the travel time to qualify, it's borderline. I would rather you qualify without any travel time because it's one of the things that they put under a lens in the case of an audit. Because let's say I'm from California and I got a multifamily apartment in Georgia, and I need to go see it. Well, the average most person who syndicates is going to fly. But if I need 25 hours of material participation, I'm going to get in my car and drive from California to Georgia. And so we normally recommend if you can qualify without it, you want to try to do that if you can qualify without the travel time. Does that make sense?
Yeah.
Yeah.
okay. Well, unless you actually do something, so, if you could document that, hey, I actually worked on the newsletter to send out to investors while I was on the plane,
Hmm.
so that's kind of what we tell our staff when you're traveling to and from, if you want to get paid, do work while you're on the plane. So, okay, great. That's a interesting little nuance. And see, this is why you need to have professional help, because they understand these nuances and most of us humans don't. Oh, sorry, I elevated you guys to a status other than human.
We got AI in the house.
These aren't real people. These are AI generated. Get to the point someday.
We're actually undercover IRS agents.
What?
Sorry, guys.
Oh.
In a way, we are the gatekeepers, right? We're the, securities attorneys are considered to be the gatekeepers for the SEC. We're the ones trying to, help everybody understand the rules and make sure they comply. You guys are in that same position. You're kind of the gatekeepers trying to make sure that people do stuff they don't get in trouble for later. And, so.
Yeah.
So my husband, he does all our own taxes. And the reason why is because he wants to take all these liberal, now I'm going to get audited, I'm sure. He wants to take all these liberal deduction, and he can't find a CPA that's willing to do it. How do you guys feel about stuff like that? Are you, are you pretty conservative about that stuff, or, do you like kind of deep dive into, some of the nuances that people can take things that might be unusual that could flag them for the IRS, but they're entitled to them?
I think we tell our clients what they need to hear, not what they want to hear. Sometimes that's really difficult, but we want to set our clients up for success. And that really looks like, from our perspective, just making sure that they're taking the necessary action steps for the strategies that we recommend. So whether that's real estate professional status or the STO loophole, We really want them to be educated and well informed about how to execute these strategies and how to do them in a right way to avoid IRS audit exposure.
Okay. Okay. That's a good question. A good answer. Okay. So you've talked about cost segregation. Can you just explain what that is in case there's someone that's never
Yeah.
heard of it?
So I was just in New York the other week, and buddy of mine said I should go check out the Brooklyn Bridge, which I was told is the eighth wonder of the world, or one of the wonders of the world, right? Well, depreciation has to be the ninth wonder of the world because you can show cash income, but you have this expense that you don't have to come out of pocket for that helps you offset the income. So on one of the long-term rentals I own, I make 12 grand a year in cash flow, but I have $10,000 a year in depreciation, so I only pay taxes on 2,000 a year instead of 12,000 a year. And what cost segregation allows you to do, if you can think about like a piggy bank, cost segregation allows, because every single property that you buy, you have this piggy bank of tax savings. And normally, for most people on a commercial property, they're not utilizing those savings for up to 39 years. They're taking them slowly over 39 years. And what cost segregation allows you to do is break open the piggy bank and pull out a good chunk of money in the first year. Typically 25 to 30% of the total value that you would have gotten over a 39-year period. So it allows you to really accelerate those deductions quicker, and perfect enough if we are also qualifying as that real estate professional criteria, because now we get to use those losses to offset our active income or a spouse's active income. And so cost segregation, amazing strategy for real estate investors, especially full-time real estate investors, to save money. It doesn't even have to be a full-time investor. I sell property A this year and I buy property B. I sell property A for a gain. I buy property B. I can use depreciation from property B to offset the gain from property A. And so it's an amazing strategy for people to use.
So, but what happens? This is an example that I hear a lot. Okay, but
Hmm.
what if I sell the property in 5 years? Don't I have to recapture all that and and still pay the tax on it?
Yeah, so there is the depreciation recapture, and that's a concern that a lot of people have. But so we did accounting and finance undergrad, and so finance really stressed a lot about time value of money. Hey, if you have a dollar today reinvested for 5 years, it's going to be worth a lot more in 5 years. And it's the same thing with real estate. If I buy a property in the right location, a good asset, and I'm managing it well, number one, it's going to go up in value over those 5 years. At least it should. It's going to appreciate. The second thing is the depreciation that you recapture is based on the value of what the furniture, the fixtures, the equipment, the property is when you sell it. So, easy example, I might depreciate $100,000 worth of furniture in year one, but in year five, I can make the argument that the furniture is only worth $30,000 or $40,000, maybe even less if the owner throws out the furniture, right? And so now I'm recapturing not 100,000, but I'm only recapturing 20,000, $30,000. So it's time value of money, because that money that I saved in year one is going to be reinvested, and I'm going to have plenty enough money in year five to pay back what I borrowed. And then the last thing I'll add too, because it's like a big general concept, is that if we're actively taking our active income, our W-2 income, and putting it into real estate, we're going to be in a lower tax bracket in the future to bat. So not only we're going to recapture less depreciation, but 5 years from now, we're also going to be in a lower tax bracket, assuming that we're moving all of our income over from active to real estate income. Does that help?
Yeah, yeah, for
Okay.
sure. That
Yeah,
that
Kim,
makes
I'll add to that. Like, we like to go over different exit strategies with our investors, like 1031 exchanges, lazy 1031 exchanges, just so they have options on the table if they do want to offload one of their assets, either in a syndication or just in their real estate portfolio. So I think that's helpful to avoid that depreciation recapture that you would ordinarily pay back if you did a cost seg and apply the bonus depreciation on one of your properties. So.
all right. So since you brought it up, 1031 exchanges. So you guys aren't 1031 accommodators, are you?
We're not. We've got qualified intermediary referrals, but we don't execute the exchange.
So if somebody wants to exchange, they have to, they can sell their first property. And then there's some rules they have to follow to identify and then close on the replacement property within a certain period of time. And they can carry forward where they can basically defer the taxes on the gain from the first property. Is that correct?
You're exactly right. So you've got to identify the replacement property within 45 days and then close within 6 months.
Okay.
Basically, the way that this is advantageous to an investor is that they can defer the depreciation recapture tax and the capital gains they would have if they just sold the property outright instead of doing a 1031 exchange. So, like giving you a good example of this, let's say in year one, the investor did a cost seg and applied the bonus depreciation one of the rental properties. And then let's say in year 4 or 5, they say, hey, like this is not performing well from a cash flow and appreciation standpoint. I'd like to offload this asset. Well, they can think of different exit strategies like 1031 exchanges to avoid that depreciation recapture and capital gains.
Okay. So you mentioned something, I thought I heard you say lazy 1031 exchange.
Yeah.
What in the world is that? I've not heard that
A
before.
lazy 1031 exchange is basically when you sell a property and then you buy a new property and do a cost seg and apply the bonus depreciation on that new property. So you're incurring the tax on the property you just sold, the depreciation recapture and capital gains, and then you're buying new property after that, and then doing a cost seg and applying the bonus depreciation on that new property.
Why is it called a lazy? Where did that come
That's
in?
a good question. Brian, you got any insight on that?
So it's called the lazy because um, the most common thing that everybody knows is to do a normal 1031 exchange, right?
Yeah.
That everybody knows that's been around forever. There are complications with doing that. Of course, you have 45 days to identify, you have 180 days to close. And also the worst place to be is a 1031 buyer in a period of declining interest rates. So if I sell my first property and I'm looking to buy other properties, I don't want to be a 1031 buyer in a period of declining interest rates because I'm going to have to pay top dollar for that next property, and I'm also going to be competing with a ton of other people or buyers. The lazy 1031, you're accomplishing the same thing in the fact that you're going to be able to uh, offset or defer some of your taxes. But the lazy 1031, there is no 1031 exchange at all. You sell your property, you hold on to your money, and as long as you buy a property before this year is over, and you do accelerated depreciation on that property, you can use the loss from the new property to offset the gain from the old property. It's like robbing Peter to pay Paul, basically.
So what you're really doing, okay, maybe I'm wrong about this, but what I'm hearing
Mhm.
that you're really not doing the 1031 exchange through an accommodator, but you're kind of creating the same effect by selling one property and then in the same year closing on another property, doing cost seg and offsetting any of that gain that you would have to pay on the first property. Is that
Yeah, same
Exactly
effect.
right.
Yep. And then as long as it's in the same calendar year, and that's where people get messed up,
okay?
right? If you sell a property right now today, you're pretty much SOL. You no chance because you'd have to buy something before this year's over. And so if you're trying to exit now, the better play would be go sell it on January 2nd. So you have the entire all of next year to plan and prepare for the tax liability. And some investors they don't want a 1031. They don't want to maybe continuing buying real estate. And so this just gives them the most options because yeah, they can buy another property if they want, or they can calculate, what it would look like to officially exit and take their money out of the real estate market.
Interesting, really interesting stuff. Okay, so and in a traditional, just to clarify for the audience, in a traditional 1031, you have those timeframes you have to comply with, and you also cannot touch the money. So you
Exactly.
have the funds held by a 1031 accommodator who's going to hold on to that money until you deploy it into the next into the replacement property. So that one would allow you, if you are stuck at the end of the year and you're not going to be able to do the other lazy 1031 strategy because you're selling your property at the end of the year, then the option for you would be to go with the traditional 1031 exchange, or at least try to.
Yeah, the only problem though is you're not going to know until 2025 whether it's not successful or not. Like if you sold a property today and did a 1031, you may not know until May if it's successful or not. Well, if it's not, guess when the tax bill's due?
You're gonna end up paying tax. So
April
that's,
15th. Yeah. So,
right. So let's just talk about tax deadlines for a minute. So for corporate taxes, deadline for filing is March 15th.
yep.
And for personal income taxes, April 15th. Okay, so this is something I always caution people about. A lot of my clients will say, well, we're just going to file an extension. All right, so let's say they have a syndicate and they have a bunch of passive investors and they can't get their act together to get their taxes filed in time, so they file for an extension. What happens to those investors that owe taxes and can't report the earnings on, they have to file an extension too, right? And then couldn't they get, fines and penalties based on the tax they didn't pay if they didn't estimate and pay it?
You want to go,
Is that-
Austin?
Yeah, so you always have to pay the tax no matter if you do an extension or not.
All of a sudden, we can't hear you, Austin.
Audio.
Check your mic, Austin.
Okay, now we can hear you.
What I was saying is that if you have a tax liability by April 15th, you still have to pay that. It doesn't matter if you do an extension to October 15th or not. So like if you've got a syndicator like an LP or GP that needs to do an extension, no matter if they do an extension or not, they're still going to have to pay that estimated tax liability by April 15th. Does that make sense?
Yes. So you've got to give your investors, if you're a syndicator and you're going to file an extension for the syndicate, you have to give your investors at least some accounting to show what they earned so that their CPA or their tax preparer can help them estimate that tax and pay it, because otherwise they're going to incur penalties for not paying it on time and interest, and they may get pissed off and ask you to pay that. So you want to make sure that you're not putting them in that situation, if you can avoid it. And you also need to make, and that's, one of the reasons that the corporate filings are due before the personal filings, is so that you have time to get the investors all the information they need, usually at least a couple of weeks in advance so that they can get their own taxes filed. So,
Yeah, and the onus is always on the taxpayer, unfortunately, because it's their tax return that gets filed. I mean, when I was working at public accounting, we would do a lot of partnership returns. We would do like a draft K1 where, hey, we're pretty much 70-80% sure this is what it's going to be, but we don't know for sure. But here's what you can use to plan. Take our word for it. But the worst thing you can do as like a syndicator is not provide clarity to your investors on what their tax liability is going to be on April 15th. Now, granted, the first year or two of a syndication, you're most likely going to have a loss because of cost segregation and depreciation and just optimizing the property. So it may not be that big of a deal. Where it is a big deal is in the event of a sale, or liquidation. That you absolutely no excuse for you not to tell your investor what their share of that liability is. You have all the information you need. You have the closing disclosure. You have the log of maintenance and repairs and improvements. You have everything you need to give them an answer as to what they're going to owe when they go to file on April 15th.
okay.
Yeah.
And I think that's important, because you don't ever want to leave your investors in a situation where they don't know a clue what they're going to get from the sale of a property, and so you should be telling them, at least giving them ballpark. And yes, you may need to withhold some money so that you've got, in case you have late coming bills or something like that, or you have any outstanding liabilities. But you do need to give them an idea of at least what they're going to get and let them pay those taxes on time so they don't get penalized. Okay, that's super important stuff. Okay, so here's a situation we run into a lot. So we have a lot of syndication clients that will create kind of a joint venture or in their GP. I hate calling it that because of course it's incorrect nomenclature, but in the asset management entity for their syndicate, they will do a joint venture scenario there where they're going to use a member managed LLC, and everybody is actively involved in making that deal work. Also, we have a scenario where people will come to us and say, look, I'm going to buy a property in a joint venture where we're going to do a member managed LLC. I've only got 4 or 5 people. So how are the earnings from those scenarios taxed? Are they all going to be considered, active earnings, so they're going to pay the highest possible tax rates on them, or is there a way to offset that?
Go ahead, Austin, if you got it.
Oh, we've lost your mic.
Hear you.
Sorry, can you guys hear me?
Yeah.
Yeah.
Okay. It really depends on how involved these individuals are in the day-to-day operations of the syndication. I need a little bit more context to know like what that looks like, Kim.
Okay. Well, so let's assume, because so where I'm going with this is in the securities world, you're either in a joint venture or you have a syndicate if you have investors in your deal. In a joint venture, by definition, under securities laws, all of the members have to be actively involved in generating their own profits. Okay. So in order for it to be characterized as a joint venture, if you have members who don't want to be actively involved, they're like, hey, I've got jobs, I just want to invest some money with you, I want you to generate the profit, you know what you're doing, then that's where you fall into the realm of securities laws, and you have to now treat this as security, that you're selling them passive interests in your company. And the typical structure for that is going to be to create a managed LLC, where just a small group of people are the manager. We have a separate entity for the manager, and everybody else is passive investors. So in the scenario one, where we have a joint venture and everyone is required by law to be actively involved in generating their own profits, are they going to get taxed at self-employment tax rates on that, even if it's income generated from an income producing property?
Yeah, so there's 2 ways of looking at it. You've got return of capital, and then you got return on investment. Return of capital is just like if you put money into the syndication or the joint venture, like let's say $100,000, and then you get a distribution from that of $10,000. Well, that $10,000 is not going to be taxed. So that's just a return of capital from your initial investment. The return on investment is a little bit different. So like if you have a property that is producing a net positive cash flow for the year, that income is normally going to be treated subject to ordinary income tax rates as well as self-employment tax.
Wow. Okay. So this, for all you people out there that think you don't want to go into syndication, just realize that your investors are not in as nice of a position as they could be if we do a syndicate. And let's talk about how they would be taxed in a syndicate. So let's say we have a managed LLC, and we have passive investors who have acquired interest in that LLC. How are they taxed? How are the passive investors?
So I'll start off with the general partners. When a general partner starts syndication, raises funds, secures financing, they're generally going to charge something called an acquisition fee to the limited partners. This acquisition fee is going to be around 3 to 5%. So let's use an example. Let's say that a GP sponsor raises capital to purchase a $10 million multifamily unit, and they decide to charge a 5% fee to the LPs. Well, that's $500,000 going to the general partner. This $500,000 is generally going to be subject to ordinary income tax and then self-employment tax if they take that $500,000 fee out of the syndication and use it for personal use. Now, there's ways to structure this for the GP in a way where they can reinvest that $500,000 acquisition fee back into the syndication to avoid that ordinary income tax and self-employment tax. And I'll talk about that in a second. For the limited partners, they're not involved in the day-to-day operations. They're passively investing. And the way that they are taxed is dependent upon what is going on in the activity in the syndication. So for the first year, they're probably going to have a net loss, just because, like Ryan said, they're doing a cost seg and applying the bonus depreciation on the property. So in that case, that loss to limited partners is going to be treated as passive. Passive losses can only offset passive income. They cannot offset W-2 business income.
And then, but so later on, when we get past those first 2 years and there are no more, the cash flow they receive, the limited partners or the members receive from the cash flow, right? So they start to receive income cash flow that offsets that exceeds the passive losses. And now how is that taxed?
That's going to be ordinary income.
Okay.
To the limited partners.
And then when the property is sold, after they've gotten their return of capital, which is not taxable, we've already established that, and they get an additional return on investment, how is that taxed?
That's going to be long-term capital gains, depending on how long the syndicator holds the investment property. If they hold it for greater than a year, it's going to be long-term capital gain treatment to the limited partners if they sell it.
Is it just 1 year? I thought there was something where there was a 2-year hold also, or is it just all like 1 year you get the line?
Yeah, the cool thing about long-term capital gains is it's just a 1 year time horizon, right? So as soon as you eclipse that 1 year, all those earnings are going to be long-term capital gains. Now, the higher tax rate you might be thinking of would be the depreciation recapture that each investor and GP is responsible for. You know, let's say the deal it's supposed to be a 5-year hold, and at year 3, instead of refinancing, they determine that it's better to sell. The depreciation recapture is going to get pushed out to all the investors and the GPs in year 3. That your depreciation recapture is going to always be higher than whatever your capital gains tax rate is going to be. I wanted to also chime in too on because normally year 3, give or take, is where syndicators or LPs can start to see tax gains. Like the first 2 years, like we said, there's so much expenses accruing that from a tax perspective, even though the investors might get distributions and cash flow, they're not having to pay taxes on that. What a lot of LPs will do is a strategy we call stacking, where like year 1 you buy into a syndication. Year 3 is normally going to be when that syndication starts turning a tax profit to you. Year 5 is normally when it's going to sell, right? So ideally in year 3, you take the money that you've gotten, plus maybe some money that you've saved up as a W-2 or a business owner, and you go and buy another syndication. And now in year 3, when you start to receive the income from the first one, you can offset it with the losses from the one you just bought. Again, it's robbing another Peter to pay another Paul, essentially.
Aren't the passive losses that the investors received in the first 2 years, can't those carry forward and be used
Correct.
to mean that they start to
Yeah.
receive? Okay.
Yeah. And the deal might present itself. So I do a lot in the campground and RV space where there is a lot of depreciation carrying forward for a very long time, to where an investor year 3, 4, 5 may still not have to pay taxes on the cash flow that they get. And so in that case, they wouldn't need to. But generally speaking, the average, I guess, multifamily or apartment, I see investors in that year 3, year 4, when they start to have to pay tax on their rental, on their passive income from the partnership.
So when a syndicator is allocating the the losses, or the portion of the depreciation and all of that to themselves,
Mhm.
how are they able to do that? So we very often set up syndicates where the asset management entity owns, or its members actually own, say, 30% of the company, and they sell off 70% of the company to investors. So are they able to take 30% of the depreciation for themselves, or is it some lesser amount?
It's normally going to be, if it's not in writing, it's normally going to be based on ownership percentage, right?
Okay.
So if in the operating agreement it says, the LPs own 70% and the GPs own 30%, well, that's going to be how the depreciation is normally going to get kind of carved out there. There are situations in which you as a, let's say LP, or even you as a GP might want to offer more benefits to your investors based on their situation. So you might offer your investors more depreciation than what they're supposed to get. In that case, it would have to be written into the operating agreement, and investors can. I would never say give them 100%, but because the investors are the ones that are putting in the capital, and they share in a risk, you can allocate more depreciation to them than just the basic 70/30, let's call it.
So is there ever a situation where the GP could take a larger share of it, maybe, because it's based on their at-risk capital, right? Or
Yeah, fancy
so
term.
they're guaranteeing the loan. Okay, and the loan is for 75% of the value of the property. Can the GP take 75% of the depreciation by saying that, hey, that's my at-risk capital?
Yeah, I mean, if the loan is recourse and the GPs are personally guaranteeing it and the GPs have money in the deal, I think they can get more than they probably can get the majority share of the depreciation. It kind of comes down to substance. Like what at the end of the day, like what are they if the deal goes belly up, like who's responsible for what? That person's going to normally get most of the depreciation. And most of your deals, the GPs are not putting in a ton of money. They might just put money in for the upfront fees and expenses, but it's normally the LPs that are putting in the lion's share of the capital injection. And that's why by default, it's normally, 70/30, 80/20 in favor of LP.
And so you said they would have to personally guarantee it, so it would have to be a recourse loan before they could really justify that, do you think?
It's either recourse or a term called qualified non-recourse. It's a fancy, if you look at a K1, there's three boxes. There's a recourse, non-recourse, and then qualified non-recourse. Just a fancy tax term. In order for you to be able to get that at-risk basis for as a GP. Yeah.
So would a Fannie or Freddie loan be characterized as qualified non-recourse?
I don't think it would ever be a Fannie or Freddie is going to be just a normal, I believe, recourse loan.
Well, except that, I mean, there's personal, so in the Fannie and Freddie scenario, they're non-recourse loans, but they require people to provide with, net worth equal to or greater than the loan amount to
Right.
the loan for certain carve outs, like if they allow illegal things to happen at the property that cause the loss, or, there's usually a whole list of things in the loan agreement that could cause the loan to become recourse. So would they be able to use a Fannie or Freddie loan and say, hey, we're entitled to a disproportionate share of the depreciation because of our signing on that loan? Do you think
If
that's
at
what
the end of the day, when you know what hits the fan, who's going to pay it back? That's the person that's going to be able to take the depreciation. So, like if Austin and I buy a property together, um, let's say it's $1 million property, I inject 100K of capital and I do nothing. Austin personally guarantees a $900,000 loan. If they come calling, they're going to go after Austin for 900K and they're going to come after me for 100. So I don't get to take a lot of depreciation because I was never at tremendous risk to begin with,
Mhm. Mhm.
you know?
All right, and do you know, or and if you don't, you can just say no. But what would be considered a qualified non-recourse loan?
This depends, but like most DSCR loans are like, because DSCR loans on the residential side, you have to personally, most of the time you're personally guaranteeing DSCR loans. On commercial property, that might also be the case where you have to personally guarantee it, but those are typically loans that are going to be that like qualified non-recourse type debt. Um,
Okay, so DSCR is debt service coverage ratio, meaning that they're loaning based on the what the value of the property, or what the income. And maybe explain that in your terms. I'm doing a bad job of it.
I mean, I really enjoy DS. I know a lot of people don't they have their hates with DSCR loans, but in my experience, the DSCR loan is there to protect the bank and the investor, um, because they will not give you the loan unless the bank feels that the deal is going to pencil out in cash flow. Typically, most of them are going to be at a DSCR rate of 1.2 or more, meaning for every $120 of revenue that gets brought in, there's $100 worth of expenses, and the revenue is enough to cover the expenses to where like nobody loses out. Like the bank gets paid, you as the investor make money, and everyone lives happily ever after. And so the DSCR loan is there to prevent people from buying really bad properties. Now, in some environments recently, there are banks that will do lower than a one on a debt service ratio loan. I've seen it happen where they will do, hey, we'll do a 0.8% DSCR if you can personally guarantee, a certain amount of capital. But the DSCR, what's really cool about and sneaky about DSCR is, and I just learned this from experience, but when let's say you want to make an offer on a property and you write your offer subject to financing contingency, okay, at a certain interest rate, at a certain term, right? And then your DSCR lender comes back to you and says, well, hey, look, instead of the rate being 6.5%, it's now 6.7 because X, Y, and Z. You can go back to the seller of the property and say, look, I can't buy it at this price anymore because my bank over here they will not finance it because it's not going to cash flow based on that new interest rate. So I've used the DSCR loan as like a really like smart negotiating tactic with a seller to get a lower purchase price. Is that too advanced or helpful?
That's great. You know what? We have all level of people listening today, so we probably got some beginners. We've probably got some people with some advanced tax knowledge. But I do think that we should go to the questions because it seems like we might have a few, right?
Yeah, it looks like, excuse me. And personally, what I'm hearing here is hire the right CPAs. You know,
Right.
yeah. A lot of this is going over my head, but that's okay. I'm a beginner. So we've got Frank Gallagher. He's raised his hand. He did have a question earlier. Doesn't this need to be agreed upon by all partners before at-risk deduction is allowed? Not sure what this was. And then a second question was in the loan docs or in the operating agreement. Okay, so maybe can
So,
we?
yes, absolutely. And the way that that's done is that we write that into the operating agreement, when you're drafting your syndication docs, whatever tax allocations or depreciation allocations you want to do need to be written into the docs. And then your investors get copies of the operating agreement and the PPM. And we talk about it there as well, explaining all of this to them. And if they subscribe to the offering, then they have agreed to that. So no, you can't just go change it in the middle of a deal. If you're, the standard is, if you don't want something special, then we're going to allocate it according to your percentage interest. Maybe the one thing that we didn't talk about though, that I think is super important is the carried interest, right? For the GP, for the asset management team. Let's talk about how that is taxed.
Yeah, I mean, so we already kind of talked about the ninth wonder of the world. Well, the close second friend is the 10th wonder of the world. That's called carried interest because that, in a nutshell, is how the partners of the deal are able to recharacterize what would have been ordinary income taxed at super high tax rates, potentially subject to Social Security and Medicare taxes, into income that is capital gains on the sale of the deal that can be offset by a slew of other expenses and losses from other deals. So when you back up, like when you have active income, W-2 or business income, self-employed, it's really hard to offset that without just spending all the money that you have. When you have income from a real estate deal that's categorized as like a capital real estate gain or rental income, it can be offset by so many expenses, like we talked about depreciation, losses from other deals. And so, what the carried interest allows, just a basic, is allows you to recharacterize your income that would have otherwise been taxed at your 37, 35% tax rate in year one, and now it's going to be taxed at a lower capital gains rate upon sale of the property. Does that
Yeah,
make sense
so
a
the
little bit?
do this. And we've talked to a lot of other CPAs, and I'm sure you guys have a way to do it that might be different than the way we do. But what we do when we create typical syndicate, this is largely the same structure for a fund. We'll have an investment level LLC. This is the one that's going to sell off the interest to investors. That's where we're going to do, maybe a 70-30 split or whatever your split is. That LLC is going to be a manager managed LLC. The manager itself is going to be a separate LLC. And so this is where we were talking
Yeah.
earlier, creating that member managed LLC structure, which is a joint venture. Doesn't have to be that. It could be actually structured as a manager managed LLC. That's a different scenario, but not really, doesn't really affect your taxes, because whatever your membership percentage is in the manager LLC, that's usually the share, your share of fees that you're going to earn. So if you own 20% of the GP or the asset management entity, you're going to get 20% of whatever fees that entity owns. So we only allow that separate asset management LLC to earn fees. And then we have in the investment level LLC at least two classes of members. Class A are all of the cash paying investors, including members of the management team. If you want to contribute cash, you buy Class A interests right alongside your other investors. You get the exact same returns they get. And you're going to get taxed the same way they're taxed on those earnings. But then the part that we carve out for ownership of the management team, okay, we don't want the asset manager entity to be that Class B member. Okay, those are the Class B interests for the management team. We don't want it to be that LLC that is earning the fees. We want it to be the members of that LLC or a separate LLC, a Class B LLC. So this is where I tell our clients, this is where in Class B is where you put your trust, your family trust, your asset protection entity, the entity that you want to build wealth for you is your Class B membership representative. And we ask our clients to pay $1,000 for whatever portion, that 30% that they're allocating to Class B. We're going to have all the members of the management team pay $1,000 for that, establish a cost basis. So then later on, all of those earnings are characterized as passive earnings earned on acquisition of the property, not for your active role in management. And those earnings then can get taxed at ordinary income rates from cash flow and capital gains rates from sale. That's how we like to do it, is we just like to have it a separation, because that way our clients end up getting two K1s, one from the management entity, all of that income being taxed at ordinary income plus self-employment tax rates, and then they get a second LLC from that investment level entity, or a second K1 from that investment level entity, and showing that different tax characterization on those passive investments.
That's in your book, right?
Yeah, it is. It is in the
Okay,
book.
I thought I saw it in the book. Yeah.
Yeah.
Speaking
So,
of,
Which you were nice enough. You were nice enough to send me a copy.
yeah, this is the book that really talks about that. I mean, both books this book kind of touches on it. This one is more beginner's guide. Oops, let's get
there you go.
beginner's guide, one's half as long as the other. This one's more your desktop reference. But yeah, we do talk about how those structured, why they're structured that way. But there's, the other reason we do that is because if the members ever mutinied and removed the manager, that your Class B interest could stay intact because they're separately owned, and it would be harder to attack those Class B earnings that were earned when you acquired the property, just for all your past efforts in bringing the deal to the table. That's how we say it. So I'm sure there's other people that do it differently. Have you seen other structures for that work?
I was going to ask, is there a scenario in which, so let's say the GP team raises $100,000 in acquisition fees. Um, is there a scenario in which they can actually put that cash in their pocket as well as not have to pay taxes on it? Or in order for them to not have to pay taxes on that, they pretty much have to roll the whatever they earn for the syndication into the deal, right?
That's what I've always understood,
Yeah.
from
Okay.
I've talked with about it, but that has always been a question, and I've always said talk to your CPA. But what suggested today is that if you do, instead of taking that $100,000 as the acquisition fee, instead roll it into a Class A investment in the deal, that you then recharacterize that as investment income, right?
Yeah, I mean, unless you really need the money now, like those you guys get those commercials where it's like, it's my money and I need it now. Do you have
Yeah.
those? Like it, but if you don't need that money, then it would behoove you to roll it into the deal so it gets recharacterized instead of active plus self-employment into the deal, and then it's going to be rental income in the future and or capital gains essentially when the deal sells.
Well, the other thing we tell our clients is it's important that you do have fees, because we have clients that come to us and say, well, I'm just not going to take an asset management fee. And I
Hmm.
think this there is that the IRS is going to say, well, you're doing some active, active activities here for running this asset on behalf of these investors. So if you're not earning any fees, then they could potentially recharacterize all of your earnings as
Yeah.
a so we like to throw them a bone, say, no, 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 this is what we get for our active role in managing the asset, anything that we call a fee. And then the carried interest, our Class B interests, our profit share are going to be taxed differently because we're considering that more of a passive investment. So
Hmm.
anyway, that's how we've always done it. And, we've talked to a lot of CPAs that have said, yeah, if you do it that way, then there's really, never a question of how why you're characterizing it differently. You're going to be better off in an audit. So,
We are
well,
almost at time here, Kim, and we've got two more questions if maybe we can squeeze them in. Mark Sherman, how does it work for a GP to roll the acquisition fee into cash investments in the deal? What are the tax implications?
that's what we just covered. So I think we got.
Ohad, Perry, if the managers incorporate in an LLC for their Class B interest later in year two, when there are some withdrawals, is there a tax event if they transfer their Class B shares to the LLC later in the game?
I'm not sure. I think you're talking about if they create a separate Class B LLC to hmm, so I see what you're saying. I know what you're talking about. It's like, hey, what if we take our interest right now as the asset management entity and then later turn it into Class B interest? I think that you, and by either, doing it individually or as creating an entity that takes Class B separate from the asset management entity. I think it's going to depend on if you do it in the first year, before you start actually earning something on your Class B interest, then there's probably not going to be any issue with that. But if you try to do it later when you're actually earning Class B interest, then somebody might question why you did that. So I think that's what how that would play out. But all right, so this has been super technical. You guys are great. Thank you for sharing this. How do people reach out to you? What's your website? What's your contact information? How do they reach out to you guys if they'd like to have you work with them?
I'm gonna put it
Yeah, we
in.
have so two places you could go to taxstrategy365.com. So that's taxstrategy365.com. We also have the largest Facebook group for real estate investors to help them save money on taxes. That's going to be called Tax Strategies for Real Estate Investors with my name, and I'll drop the link to that here in the chat if you guys want to check it out.
Yeah, you said
Can you
Facebook, right?
say it again, tax strategies.
For real estate investors? Yep.
And that's
I'll drop it in the Facebook group there. Or I'll drop it in the chat.
That'd be
Everybody
great.
can see that, right?
Yeah, I think so. Oh, wait, hang on. Let me just copy that and put that to everyone. There we go. Now everybody should see that.
okay, excellent. So that's a Facebook group. All right, so thank you so much. Anything else you'd like to add that we didn't cover?
Yeah, taxes are going to be the biggest expense out of every single person's life. The more that you can save, a lot of people are focused on like earning more, like earning more money. I think it's great. A good starting point is to say, well, what can I just be saving? Like what can I subtract from my life? When Michelangelo built a statue of David, he saw that slab of marble and he said, he didn't say, what can I add to it? He said, what can I take away from it? So I think a real good starting point is to just, what am I doing that's not as tax efficient as it should be? Let me save money there. And then let me go and grow my portfolio even larger and utilize those tax strategies that I learned to get cash flow and pay less in taxes on it.
That's great parting words. Thank you, Austin. Thank you, Ryan.
Awesome.
Thank you.
Podcast, and I hope you guys get some calls out of it. And we'll see everybody here during our next podcast.
Thank
See you guys.
Thank
Bye,
you.
everyone.
Bye.